Hi, and welcome to Slot Leader, a podcast that bridges the gap between the traditional finance and business world and that of blockchain and digital assets. I'm your host, Umed Saidov. In today's episode, we'll be focusing on cryptocurrency trading. Now, a lot of you have expressed interest in this subject, so I decided to invite Colin Edwards back. Some of you might remember him from previous episode. He is a quantitative strategist at IOG. He is also an ex-Goldman Sachs trader. And in today's episode, he is going to appear in his personal capacity to talk about his personal passion, which is trading. So in the in-depth interview that we have with him, we talk about how he sets up a trade, we talk about how he executes the trade, and we talk about some of the pitfalls that traders might have and how to be cognizant of them. The interview is filled with a lot of interesting insights, and I hope you enjoy it. Before we go on, I would like to remind our viewers and listeners that Slot Leader is an educational podcast, and as such, we try to cover a range of issues in this podcast. Now, anything that we do or say in this podcast does not constitute financial, investment, legal, or tax advice. If you like the type of content that we're putting together, you can subscribe to our YouTube channel, or if you are a part of Cardano ecosystem, you can delegate to our pool, which has tickers SKY and SKY2. When I scan the news in the blockchain industry, I usually look for the types of news that have some form of a fundamental effect on the blockchain and its adoption. And in this week's news event, I'm going to talk about the DBS Bank, who reportedly has started working on providing their clients with digital asset custody and exchange and security tokens. According to the report by Cointelegraph, they have posted their new service on their website, and that webpage has been taken down because they have not yet secured legal approval. But nevertheless, the details have been out, and it looks like they will provide custody of digital assets. They will provide the exchange of digital assets, not unlike PayPal, for instance. And on top of that, there will be an avenue for clients to buy, I guess, and exchange security tokens. It's another good and positive event in the space that takes the adoption one step forward, because we know that the digital assets space needs on-ramps and off-ramps from the traditional financial world in order to grow. When it comes to Cardano, the latest product update by IOG takes the center stage. In this latest product update, we saw a lot of interesting features that will be rolled out when Goguen comes. Now, for those of you who don't know, Goguen marks the next stage in development of Cardano's ecosystem, which will have smart contract capabilities and other token capabilities, the way that ERC tokens are represented in Ethereum. But in contrast to Ethereum, in Cardano, it looks like we will have the tokens before smart contracts, and it looks like we don't need smart contracts in order to manage the tokens on Cardano's ecosystem. And that is because in Cardano, the tokens are treated as first-class citizens in that they follow the same logic, they follow the same consensus mechanism as ADA does. And it presents itself as a lot of opportunities for developers who might want to take advantage of these properties. I will leave the link to the podcast or the crowdcast to this product update that you could listen to and get a sense of a scoop of what's about to come. Now, since the last time we covered the ADA's price, it came down, it looks like, from 11 cents to around 9.3. And if you look at the prices and just purely from a technical point of view, I don't see any other fundamental changes in technology or fundamentals of Cardano. but it looks like on 25th, the prices entered a sort of a bearish territory, in a sense that the ADA started trading below its moving averages, and maybe the algorithms started trading it down because of that. I was hoping that the event driven strategies on 29th would push it back up, because there was a major news announcement about the developments in Cardano and what it could bring. And I don't know if that generated enough positive sentiment. So we see that the price trended down after the announcement, to around 8.9 cents, and it's been trading up a little bit, and it just crossed the 7-day moving average, and it's about to cross the 25-day moving average. And if it does happen, maybe the algorithms will push it up again. But yes, at this point, it's trading below its 99-day moving average, and at around its 25-day moving average. We'll see how it works, but there might be more insights for you guys in the interview section of this episode. We're going to break this session into several segments. Colin is going to walk us through trading basics. We're going to talk about how to set up a trade, what kind of tools did you use, et cetera, what kind of strategies we see in the markets, and what he uses in his daily life as a trader. And then we're going to go and do a deep dive into an execution of a trade, where he will walk us through different parts of the trade, and give us his view about how to execute those trades in detail. He will have some interesting visuals for us to see, for those of you who are watching this podcast. And then we're going to talk about psychological traps, because every trader has them, and how to avoid them. So that would be basically the basic setup of this in-depth podcast. And without too much waiting, I'm just gonna give the floor to Colin Edwards, where he's gonna start.
Thank you. A couple of things I think are really useful in my own thinking about trading, and that is I tend to mentally separate investing from speculative trading to kind of what I think of more as market making type trading. And so there's a buy and hold aspect that, either you pick good names and you do it and hold it forever. And sometimes you're going to pick winners in markets and win big, but there's a lot of what I think of more market making, of just trading back and forth between names to pick up profit. And that's really what I'm going to focus on here, is that aspect of it. And I think that's a very useful aspect, because it informs the rest of the trading that you do. So many types of algorithmic or market making strategies are very sensitive to the execution costs. So looking at the fees and the slippage and the tracking of those are very important. And I think there's also a really good discipline in trying to understand what's actually happening in the markets that are underlying the prices. And one of the things I wanted to just start sharing is perhaps an order book. One of the things about crypto that's a little bit different, make sure I get out of the light here, is that you actually have a lot of visibility in the order books. This is something that on more established exchanges is very expensive. It may not be available to individuals, but on crypto exchanges, and practically all crypto exchanges, will just make the order books public. And there's just a vast amount of information and data in those order books. And these are the things that give financial traders often an edge over other market participants, is not just looking at the prices, but pulling in data from other sources. And some of those are derivatives, some of those are news or sentiment, and some of those are the order books. So these are fairly important, and something you don't see a lot in other types of trading like stocks or bonds, simply because you can't see the order books.
Colin, to that, I would like to basically ask you the first question, and that is, how do you pick strategies, exchanges, and how do you set up your code? Is the news something that's important? Can you go over those in the first sort of segment?
Sure, I can talk a little bit about that. So normally I trade in coins that I have some or products that I have some belief in. If I'm stuck with them for an extended period of time, I don't want to feel bad. So I'm generally holding or trading things I'm at least comfortable with the technology, with the community, with the vision of the product, and that limits. And some of that is reading the white papers. Some of that's going in and looking at GitHub repositories. Some of that is looking at ratings websites and or the community itself or other projects people have. So a little bit of due diligence on coins. I tend to focus on certain coins that I like the technology or which are quite responsive or moving together as a group. So I don't have an example of it, but one of the things I often look at is principal component analysis, where I'm going to look at coins that share the first, are very tightly correlated in the first principal component and have a difference in the second, usually representing something specific about the coin. And it varies on what it means. I mean, when you're talking PCA, it's often a little bit hard to know exactly what it is, but that gives you a little bit of something to trade on. So the first thing I normally do is plot the principal components and then do what's called a scree analysis and look for things that are tightly correlated in at least one dimension, but have enough variance in the second that you can trade around it.
All right. And you talked about exchanges. Can you give us the rationale for picking certain exchanges?
I think when you're trading in volume, there's certain larger exchanges that are worth trading on because you can trade in enough volume to make it worthwhile. I also like looking at smaller exchanges with less liquidity. I think there is a tremendous need for liquidity in those markets, and just coming in and essentially buying when people want to sell and selling when people want to buy is adding a lot of value to those communities. And one of the things that we are evaluating or have looked at internally at IOG and talk about is a market making function, or especially around things like tokens or coins that might be issued about, if you can have a liquid market where people can buy and sell easily, that there's a lot of support for that. Try to get some of the volatility out of it. This is not something we're engaged in right now. I'll just say there's some legal considerations about whether or not we would be able to engage in that ourselves, or we would work with a partner on that.
Okay. One of the things that a lot of people look at is technical analysis, and just to basically put some of those concerns or aspirations to rest, can you tell us if, in your experience, because that could create a can you tell us, in your experience, if the TA in its pure form, and that is looking at volume and the price, works in crypto? Because a lot of people focus on that alone in the crypto sphere.
I can only give my experience, which is I've had terrible experience with it. Yeah, and part of that is I track, just versus luck. I have about the same luck, rolling 2 dice 6 as I do in picking a strategy is using technical analysis. So those are strategies that have not worked for me. I think there are, and I will show you this. Actually, let me share my screen, because I think this is a very interesting case of technical analysis where, actually, let me see if I can get this. I'm going to try to share a Jupyter Notebook. And one of the things that we see in crypto markets, and I'm trying to show the high correlation here. Hopefully you can see that here at the top of the page. Is because the markets are so very correlated, one of the things that you would expect in something like technical analysis, where you're looking at resistance levels or perhaps different shapes or patterns, is that coins would themselves exhibit slightly different behavior. And one of the challenges in the market is that coins are, in fact, very, very tightly correlated. And so certain types of things like resistance levels, I think, are strongly not present in the market. I look at the time series and data and say that that's, not there at all, or where it is there, it exists only on Bitcoin. I'll hedge that a little bit, but on everything other than Bitcoin and everything else is tied enough to Bitcoin that they do not have themselves separate resistance levels as far as I can tell. And other types of shapes, I've not been able to get those strategies able to perform better than just picking the direction from yesterday and trading it. I mean, it's sort of as a, straight up momentum. If you can't do better than that in your trading, there's not a lot of signal. And I think when you look at those technical strategies, they are using only one subset of information, pricing, where they're ignoring many other types of things that are happening, whether that's news or economics or social media effects. So I think adding more data in there is helpful to get a bit broader picture. And more than that, I think that when you look at algorithmic trading, some of those patterns that people look at, a, a reversed V pattern, or some sort of fractal type patterns that appear, those are not things that are generally picked up by algorithmic trading. And algorithms have become more and more part of the marketplace. That also kind of forces those strategies out. They that kind of pattern analysis. My experience is it hasn't been very effective. So if it
I
works
see.
for you, don't don't stop on my behalf. But I haven't found it personally very effective.
Yeah, and so the reason why I mentioned this is, one of the ways to generate value and create some insights from this podcast is basically to tell people what, in your experience, hasn't worked, so people don't waste their time, and then focus on what you've done and what has worked for you in that respect to create that value for people.
Yeah, I
So
think
that's why I mentioned this.
in technical, one thing that does seem to exist is momentum. That
Hmm.
particularly, I think that when you look at momentum, especially when you can identify what caused it, is people often buy into things that other people are buying into, and whether that's trading off the hope or the expectation they have inside information, and so people just jump in, or for whatever reason, there does appear to be a bit of momentum, and
Okay,
so I think that many momentum theses are valid. I think that will give you some idea of what people are going to do. And
and
that's an effect that feeds on itself. As you get
it's
more
a positive
momentum,
feedback
you
loop.
get more chatter in the media, you get more attention, that draws more people into the trade. And so there is this effect, I think, of boosting up. So of technical analysis, I think the momentum measures are pretty effective.
I agree with that. I think in equities market also, momentum is part of the game. But how would you describe the momentum? Where would you place the sort of a flag that tells you, hey, this is a positive momentum or this is a negative momentum? How do you size that momentum?
Normally, when I look at that, I look at what's happened historically. Often, I'm going to be looking at historical volatilities
Hmm.
or moves and saying, we've had this is probably not an entirely new effect. This is something that has likely existed on other coins, and often momentum's caused by something like a news article or an actor. So you can say, and I think with news, people say, buy on the rumor, sell on the news, or things like that, where you can see an article or a news event comes out, detracts a lot of attention, that changes the supply and demand, kind of dynamics. It increases the demand in a short-term way, and maybe in a long-term way, but it tends to overshoot. So there tends to be an overshoot, and it comes back to potentially a new equilibrium, but not at the peak. And I think those are things where you can look at the momentum, and you can make some analysis about it's going to follow a similar pattern. It's going to be somewhat higher than maybe it is right now, but there's going to be a buying event with a sell-off at the end of it where it kind of corrects. And I think that is something where you just look at supply and demand is generating short-term interest, which is short-term supply. There's potentially some long-term interest, or I should say short-term demand, and then there's a long-term demand maybe as it just gets into more of the public mindset. So things that generate long-term demand, I think, and those are going to be things that make crypto look more like a investable markets. So things that, for example, I think news of major players coming investing in crypto, government organizations that are involved in crypto. Those are big events for the markets, and those generate long-term interest in the platform. So certain things like that, I think, are very important in news events, but they're not always just there in the price. I think they're in looking at price alone, you're going to get picked off. And in particular, I'm going to talk a little bit about mean reversion trading, and news is the enemy of mean reversion, in the sense
Yeah.
that you're seeing things that have temporarily diverged, and you think there's no reason for it. There's no difference in these projects. There's no long-term reason that these should be. This is a transient effect, and it should come back. So the other thesis that sometimes happens is um, these things have diverged on expectations of something happening. So I think any kind of mean reversion strategy benefits from at least some news scraping to say, is there any chatter about major releases? What's the release schedule look like? And those are things, again, that you're going to want to break away from just strict looking at prices and doing a little bit of research about what's happening in the markets. Of, if they're coming up with a big release, trading in front of that, you don't want to be doing mean reversion. You probably just want to sit that one out and just take the cases where somebody was just selling out. Some big player wanted to liquidate and they were going to dump it in the market, or somebody wanted to build up a position and they're willing to pay a premium to do that faster. Those are really strong cases for mean reversion. So I think scanning news is going to be really critical for anyone.
Oh, that's wonderful. I mean, from what I'm gathering from this conversation is that you have to have the right strategies. You have to be able to read the code and understand what you're buying. If you get stuck, you have to be very cost cognizant in terms of the the um, the fees that you pay in exchanges, and you have to also stay true to your strategy in the sense that if things diverge and the landscape changes, for instance, in the case of your mean reversion, you have to be able to turn it off and wait until things die down, depending on your strategy, of course. Would you be willing to talk about the trading APIs and what kind of APIs you use and what works really well for you in in um, in,
Sure.
in terms of exchanges and stuff?
Well, I honestly think that most exchanges now have kind of converged. And this is a really exciting time because all these exchanges were created, I think since 2010. So they all tend to have very modern, easy to use interfaces. So both REST APIs and WebSockets are so easy to implement. And I think, for example, Binance has a wonderful API. That's a very easy one. I use another exchange called Tidex, which is a very similar REST API for trading and a WebSockets API for data and pricing. And they're implementable with a couple lines of Python code. That's not complicated programming. There's very good tutorials on the sites. The Binance API site will give you even the sample calls to make, and just really easy to set up. I think that when you're trading, the biggest thing is security. I think that having certain codes or certain whitelisting addresses, using physical keys to access your accounts, and requiring those to be in the computer to trade are quite important. Otherwise, you're kind of just opening yourself up to a lot of issues. And so those are things, and particularly moving your money off of an exchange is something that I would strongly recommend, using something like a physical key. I've got a physical key I have to plug into the computer. That's, I think, a case where there's just no reason not to go out and spend $20 on picking up a piece of physical hardware you have to use to withdraw your money.
All right, perfect. Now that we have some sort of a setup and basics covered in trading, unless you have more, we could go through the execution of trades. We can talk about different trading strategies and how you execute them and how they played out. I think that's a very exciting part because you can see the trade playing out in real time, sort of. So why don't we get into the meat of this whole thing?
Sure. I wanted to go ahead and just start with an order book, because this is one thing I think that a lot of people, when they look at prices, actually miss, is how an order book works. And the difference between what you think of as makers and takers is sometimes you see on different sites. And a maker is somebody who says, I'm willing to buy or sell at a certain price. And makers are people that bring liquidity into the market. So I
Colin,
say,
can I ask you to expand or zoom in to this window, because it might be a little bit
Let
smaller.
me see if I
Yeah.
can zoom in here. Is that bigger or not?
Nope. Oh, I guess we don't have a choice. It's fine. I can go ahead.
Let me see if I can zoom in. I'm looking at, I do not have a zoom, or maybe I do. No, I don't.
Okay.
I'm looking to see if I can zoom in. Um, one of the things I think when
There is a zoom ratio on the window that you're sharing. I think. No,
is that helping or not?
it's on my side. At least there is. Okay. Is that better? I think that's. Oh, it's. I had to do this. Actually, sorry. That was my. I should have done that. Yep. We got it now.
All right. So one of the things that happens, I think, is you have buyers and sellers that are available in the market, and these are called makers, and they're the ones that are providing the liquidity. So when you go up to a market maker, you can say, I'm going to either buy or sell, and ask what you're going to buy or sell at. And there's a difference called the spread, and that is the difference you pay between buying and selling. So I might be willing to buy at one price, say $10, and sell at a different price, $11 to you. And I might even have both open at one time, so that I'm willing to do that difference between buying and selling. And when somebody comes through and they, let's say in this case, wanted to sell some coin, that trade then gets taken out of, the other side of it gets taken out of the order book. Liquidity is removed from the system, and then the price moves up a little bit, and the spread widens. And this is a very useful thing to think about, because when you're thinking of buying or selling in any quantity, you can think about how far you're going to punch through the order book to an extent, and move it. So you can trickle in a little amount and not move it at all, or you can try to move a larger amount as you go through. And one of the things that you typically see in a lot of cases is there are impatient buyers and sellers. They will just want to get their trade done. They don't want to wait any period of time. They just want to put a market order in and get executed and go back to the football game or whatever. And so there's a lot of money actually just sitting around waiting for people to come and trade. And I would take it off somebody for a certain amount. I'd say I'm willing to take it off at a 5% haircut, and I'll just turn around and resell that over the next couple of weeks or days or hours, depending on the trade. And then this is there's a lot of professional market makers that do this on different levels. And when you look at order books, one of the things in order books is there's a lot of people that are kind of sitting a little bit away from kind of where the market is. And I'm going to actually change my screen for a second just to show Binance. Let me see if I can actually do this. I'm going to see if I can share a different window. Just going to try to open this up and say this is Binance. And one of the things that you can look at in Binance is the depth in the order book. So, and what we really have out here is there's a lot of people right here at the center. There's a little bit of trading, but if you want to trade larger amounts, there's just a lot of bulk. The people are just kind of waiting around for big orders to come through, and they're willing to take big orders. And here there's kind of this threshold. If once you want to move beyond 5% of the price, then there's a lot of people that are willing to take on that position. So that's kind of where it's priced right now. It's about 5% off. You see this step change, and this will change as the market moves. So if the market were to move up a couple percent, this would just shift over to the right a little bit, or if it goes down, this is kind of this big wall is going to move a little bit to the left. So they don't really represent stable value.
By the way, are you trying to show the order book? Because all I'm seeing here is a chart.
Yeah, the green and red, and
oh, I see.
That's one representation. We can look at that a different way here. I'm going to just look at it in here is the actual physical representation of the trades. You can see the same thing. I'm just going to
I don't see it, Colin. I am stuck at that chart, and if you're switching tabs, I'm not able to see it.
Okay,
we'll edit this part, but just
let's see if we can. I've actually now switched the screen, so I'm no longer on that same tab.
Huh?
or I'm on the same tab, but I haven't switched my, I'm no longer on the same chart.
That is interesting because I'm just stuck with that chart. It looks like. Let's see if I can do this. No, doesn't seem to help.
Because I have now changed my screen here, hopefully. I've switched back to this chart, but.
Can you go to a different tab? And so I
Sure, this is a different tab now.
No, it doesn't do any change. Doesn't change anything for some reason. That's really weird. Do you want to do a restart the screen sharing maybe? Like
sure.
Turn it
Let's
off.
see if we can stop that and share it again.
I'm sorry. I mean, I'm just trying to.
No, I think this is getting these technical issues sorted out is always a challenge. Let's see if I can do this now.
Okay, well, we're better, I think.
So this is just the trading screen on Binance.
Yeah.
And I can go to a couple things like the depth in the order book is viewable as a graph, or we can see the order book along the side, or I can actually zoom into that order book here. Hopefully this will just show the actual order book, and I'm going to sort it out. And you can see the orders moving through where people are sitting out there willing to trade at certain levels, and the book is kind of bouncing around a little bit. And it's depending on the buy and this, the people who want to buy or sell at a given point in time. This is, you can see that actually happening here. This isn't too useful to look at. It's a bit hypnotic. But the data behind it is actually kind of interesting. I'm just going to switch back to my exchange view here, where I'm looking at
the depth.
The depth, and then I'm going to just actually look at the prices. So down here at the bottom, we can see buy and sell orders coming through. And for example, this green spike right here is a big buy order that went through in quite a hurry. And that caused the price to immediately rise up. And this is the kind of thing that a market maker, you can make money on just by sitting a little bit away from the order book and saying, okay, I'm going to, if the price moves 2% away from spot, I'm willing to take that and fill that order. And then I might, take whatever I've earned there, and I'm just going to turn around and resell it back for, a lower price or a higher price. So I'm going to buy cheap and sell a little bit higher. And I just need to kind of make a little bit ahead of my costs. And there's a variable fee schedule on that, but most crypto exchanges are very advantageous towards makers. Binance not particularly so, but particularly smaller exchanges have a very attractive fee schedule for people that are coming in there and improving liquidity. Liquidity in crypto markets is just a non-ending problem. They're matching buyers and sellers up. By liquidity, I really mean putting together buyers and sellers, and often that's done by middlemen who are willing to buy when people want to sell and sell when people are going to want to buy. And that process of kind of facilitating is not there. And particularly distributed exchanges often suffer from wild price moves because people are just not available at the instant that people want to buy or sell. A lot of people want to come in and buy it and can get their order done with and finish up. So if you're willing to wait an hour or two or 6 hours or even a day before you're filled, you can often get much better price execution just by waiting for the market to come to you. And you do this in a couple of ways. One of them is you make the other side of the bid ask, so that instead of executing at the ask price, where somebody is willing to sell right now, you're going to be coming in on the other side of it where somebody's is willing to, take the other side of the trade. And you also benefit from a different fee structure. You often pay much lower fees. And Tidex, for example, the 0% fee on market makers. highly advantageous, so that you can, the other guy is taking the whole fee. That and all in what you're really giving up is some time. Your money's sitting there on the exchange for a bit longer, but you can get a lot better execution, and that adds up pretty quickly. If you're making 1-2% a year better execution, if you're in a market where you're making 7, 8, or 10% annually on your investments, an extra 1 or 2% is a big number. That's a very attractive number. It's not gonna, go to the moon or buy you a new car, but over time, an extra percent here or there. So I think a lot of trading is just about not leaving money on the table.
Yeah. So that kind of brings me to a question. How often do you need to be right to make this trading as a activity worth it? So what can a trader expect to make on his investments? Let's say that I have 100,000 ADA. What can I get out of it trading?
Well, first of all, I recommend you don't trade with your ADA, because ADA is awesome and you just want to hold it. And so, I think one of the things with trading, and this is kind of, is you can't have too much of an emotional attachment to a coin. So if you really like a coin, you're not going to want to sell it. You're always going to be sitting there kind of feeling, I should hold this coin, I don't want to sell it, and you make bad decisions. So only trade stuff that you kind of like. You don't mind sitting on it, but you don't like too much, because if you like it too much, you're going to hold it when you should sell it. And so I think that's one piece of advice psychologically, is if you're in love with it, just buy it and hold it.
Okay.
Don't trade it.
Okay, let's take Bitcoin or Ethereum for that matter. I mean,
exactly. I think Bitcoin and Ethereum are great. I like trading Bitcoin a lot. And the reason is it's kind of a reserve currency for the crypto market. A lot of miners, there's a lot of markets that you can trade Bitcoin against. And I also like it, and also Ethereum, where you've got a lot of pairs for it, because they're highly correlated, because the market moves very much with those coins. You're never in a situation where the market as a whole runs away from you. If you were trading against, say, Tether or another stable coin, the crypto market could just move away from you and you'd miss a lot of the run up. Whereas when you're trading with pairs, you have a situation where you could miss a run up on a particular coin, but you're going to pick up a lot of the general market moves. So I tend to like trading strategies that benefit broadly from the market, and you don't give up those markets. So trading between pairs, I think Bitcoin is a great example of where there's broad markets. You can trade on many exchanges, and so that is something I quite like, instead of coming in and ever going to fiat.
Okay. Have you looked at your trading strategies that you have or employ on a daily basis, and benchmark them against random or monkey throwing dart? And what are those results?
That's a good question. I tend to go for strategies that have about a 70% success rate. And the reason is there's often costs that you don't associate, and timing. So sometimes it takes you a little bit to execute, and even if you have a good idea. And so you need to kind of bake in, and particularly for things like algorithmic trading, you want to have a feeling of a pretty good success rate. You can't just be coming in at 50%, or else you're going to lose a lot of your profit on just fees. So I think when you're looking at algorithmic trading, you're about 70%. For market making, it's actually just a lot of back and forth. And that is one where you can very conservatively just look at where markets are moving, and you can make a percent here or there every couple days. And, so let's say if you had one Bitcoin worth of money on the exchange to trade, you're making, and this is quite different than the people that are market making all the time. They're in and out, but you're kind of just waiting. I like to pitch things that happen about every 10 days. So I'm looking for events and people that are selling every week or two. So a little bit more frequently than 2 weeks, but less than it's sort of between 1 and 2 week events. And you can have some idea of these events that come in along with a certain probability. Kind of the value at risk measures are pretty useful ways of identifying events that you think are going to happen fairly frequently. They're not outlier events, they're not the go to the moon events, but they're things that are going to happen every couple of weeks. You see the markets move down a certain percent, and you can be making those. So I think aiming for a percent or two every week, or even every month is pretty good. And then whatever your costs are. So
Yeah. I'm
if
kind
you
of surprised that you actually have that time frame, because given the volatility of the asset class, right? You are exposing yourself to these idiosyncratic moves that have nothing to do with your main strategy. Let's say that you are market making and you're saying, okay, I'm buying something right now and I'm going to turn it around and sell it at 2% or 3% in 10 days. And now within those 10 days, you could have huge market moves that could completely obliterate your strategy. How do you guard against those things, and how often do they happen? And I mean, that would be my kind of con case for that kind of a strategy. And I would like to know, how you manage that.
what I think is looking at coins that you like enough to hold them anyway. So I think when you're looking, particularly, I think this is, if you're trading between two coins, and I'm going to say, let's say you got a Bitcoin and something else,
Hmm.
and you're trading between the two coins, you're going to take a lot of the market moves anyway. So if the market doubles in some ways, and Bitcoin's actually been a lot less volatile in the last couple months. So Ethereum might be a better case right now, but you're going to profit a lot in those market moves. And even if you're holding the other coin, let's say that you're holding EOS versus Ethereum, there is going to be a high correlation. So when the markets go up, those are cases where you're going to benefit on one side or the other, and you tend to make or lose, regardless of which coin you're in. So I think part of that is just not ever thinking about it in real currency terms. You're kind of just trading back and forth around. I've got a trading revenue of a Bitcoin, and that's my stake. If I make money, I might pull it down. If but you're mentally just thinking, I've got a Bitcoin,
Okay.
and so you're not thinking about it in dollar terms. So if Bitcoin goes to 20,000 or Bitcoin goes to 4,000, you're still just on a Bitcoin. In the same way that you probably don't think of your U.S. investments in terms of anything except U.S. dollars. You're probably not thinking, oh, in British pounds, I just lost like a lot of money. It doesn't matter. You're just trading back and forth in your currency of reference. So I think that's one of the reasons that holding a coin as your currency of reference rather than a fiat uh, is a little bit easier psychologically.
Yes. Yes. All right. Colin, can you pick one or two strategies and walk us through them? I know that you've got some really cool charts there that you were sharing with me earlier.
Yes, indeed. Let me see if I can pull this up. I'm looking for there we go. So this is, one example of market making, and this is something I think that most people can play in without a lot of problems. Is let's say that you were just interested in a coin. I'm using an example of ERG here, and I'm using this example specifically because it's one that one of the other Cardano organizations, Emergo, had been in a partnership with. I have some faith in their due diligence process, so I feel more comfortable than just a random coin. And so this is one where I thought, well, this is a coin they some people that I trust like, and therefore I'm willing to do a little bit of market making on it. And this particular exchange is Tidex. This came through this morning, and one thing that happens a lot, Tidex doesn't have very good liquidity, and in fact, it's got terrible liquidity. But you do see these miners come through, and so this morning, in particularly in Asian hours, I often see miners will come through and just dump. I'm assuming they're miners. I don't know that for sure, but somebody comes through in Asian hours between say midnight and 4 a.m. UTC, and dumps a large amount of coin, much more than the volume in that exchange can handle. And one way to profit on this is just to sit out. So the coin is up here at about 0.6. This huge order comes in that is just outsized, and it tanks the price all the way down to 5. Now, this doesn't represent a real change in the valuation of the coin. It's just a miner looking to make profit for it. And so if you're sitting out here in the order book at 10%, 5% outside the order book, you can pick up a pretty good price, and then you're just going to turn around during the course of the day and make it available for sale at higher prices. And you think, this isn't somebody with inside information. This is just a miner looking to liquidate. I'm going to go and offer it at prices basically where it was before this guy came in. And you can sit there and now, I mean, we're sitting here a little bit after lunch in the UK, and the price is largely recovered to where it was before this miner has come in. And you think that's, a 10% return just by sitting out there and accepting the trade. And this is, number one, I think this is something you're providing a service. That guy wanted to move his coins. He was in a hurry. He didn't necessarily want to spend a lot of time. I think a lot of miners have mini coins they are interested in. And they want to just convert it out to a stable coin. And so you're providing a service of liquidity. I'll give you your money in a hurry. It may sound like payday lending, but those are things that, you can just give them their money and they're out of it. And they don't have to market make. They don't have to trade during the course of the day. And then as people come in, and maybe during the UK or European or US hours, there's more buying action because the mining tends to be in Asia, and then the buying happens for the next 23 hours and it comes back. And you just turn around and resell during those hours with a little bit of automated trading. And this is a very easy way to make money. There's a limit to how much money you can make in the sense that these exchanges don't have a lot of volume. The entire transaction here might have been for a Bitcoin. So you're not making huge amounts of money here, but it is consistent. And these kind of minor rewards will come out every couple of weeks, and you can take a look at the schedule. But this particular guy, he sells about every 2 or 3 weeks, and I don't know who it is.
Okay. Well, I mean, this particular chart actually begs a couple of questions from my side. So, if you are a market maker, right, how do you differentiate between an event that was random by a miner, as you described it here, and something that actually impairs the valuation of a coin? You must have some sort of a scanner that scans the news, so something actually happened versus nothing happened, and this is a buy opportunity.
Yeah, there's a couple of things in there. One of those is you could use a news scanner. I use Crypto Compare has as a news feed where they rank articles for you, and you can do kind of word searches on the articles. And if the coins pick up those searches, that's certainly one. Google Trends I also use, so that if the name is starting to trend up in Google, often that would be a warning signal that people are doing something unusual with it. I think the Telegram groups are also quite useful to scan. Just looking at chatter in those, they often will have some information up front about major events or announcements. So, knowing when different coins come out with announcements. For example, in ADA, the at the end of the month, every month, they have a news show that they're often going to come out with announcements. And so that might be a period of high volatility, whether or not those announcements match expectations. And this is true of a lot of other coins. You can kind of look at when they tend to make announcements, look at when they're going to be, many times they have a development roadmap that's publicly available with dates set to them. And you might just want to hold off around those dates, whether or not, they're hit or not.
Now,
you can make a decision.
Yeah. Now, if you could clarify here, is this trade something that's automated? Oh, in other words, do you have a script that scans the news and tags the news articles as positive, negative, or neutral, and depending on that output, makes that trade or places that order? Or is it something that you do manually? And I'm particularly sort of interested in trades that might happen, or trading opportunities that might happen when you're sleeping?
Yeah, it's a mix. I think part of that is you don't want to spread yourself too thin around a lot of coins. You kind of want to keep up with what's happening on them and the news around them. And I think having an off switch on any algorithm is a good idea. That it's just a kill switch until somebody comes in, and you might give up some profits. You might miss an opportunity, but at the same time, I think that you do dodge enough bullets too. So even if your algorithm, I may not have a very good algorithm, but I can certainly pick up Twitters and do some basic. I use a library called Vader, which is it's publicly available. You can Google for it. It's on GitHub, where it's just looking at basic sentiment and negative words, and it's specifically kind of some of the words. The library I use is more focused around trading specific words. Um,
Okay.
However, and that will just be a kill switch. So, it's just take everything down until I have a chance to think about what's happening.
Okay.
And
Okay.
those are events where uh, you need to think about which way you are. For example, I'm generally okay about trading out of a coin. So if I've got something where I'm going to get land back in Bitcoin, I'm usually okay with it. Where I'm a little bit more concerned about is coins that, where I would pay Bitcoin for a coin. So purchasing, I might pull off, but I'm almost always going to have that kind of sale back to Bitcoin being okay. So it's not both ways.
Okay. And one of the things that popped into my mind when I was looking at this chart was, how do you decide at which level you need to sell? And I'm following this price chart over here, and the coin recovered, but it recovered slightly lower than before the dump. And how do you determine the exit level?
This is
Exit
a good
price?
case of I use actually a methodology called value at risk. It's a widely used risk management framework that communicates what kind of outcomes are likely, what kind of gains and losses should we expect in the market based on historical trends. And this particular value at risk chart uses a methodology called exponential weighting. It's got that very jagged arrowhead shape. There's other ways of looking at value at risk. This particular one uses kind of an old risk metrics methodology with a 95% decay.
Mm-hmm.
But this is a different coin here, but you can look at a coin like that and say, I have a certain feel for how likely a 5% move is or a 10% move. So if I want to be, say, executed every 10 days, I want to put one trade in every 10 days, I can be sitting out here at a level that is let's say a 90% VAR, or if I want to be executed every 20 days, I might be at a 95% VAR level, or every couple of months, I might be sitting out at a 99% VAR level. So these are things that I just expect by where the markets tend to move on an hour, and I tend to look on an hourly basis. But this particular coin here, as you can see, it's not unusual to have an hour where it moves 5%. So
Okay.
that would be a case where, I might put in a trade that I expect to get executed on once a month at about that level. So normally I think mixing your trades so that you've got a couple lower levels that you might expect to get executed every 5 days, and a higher number that you might expect every 10 days.
Every time I interview Colin, we lose track of time, and this one was not an exception, this interview. So we had to break it down into two parts, which means this is the end of part one of episode 7. And if you would like to join us to continue the conversation, to continue listening to our in depth discussion, you can join us for part 2, episode 7. So see you soon.